What if the biggest financial crash in modern history didn't start in New York, London, or Beijing, but quietly in Tokyo? Hidden inside bond markets almost no one watches, because while headlines chase stocks and crypto, the real danger is unfolding in the plumbing of the global financial system. And Japan just pulled a lever worth over $1.2 trillion that could change everything. For decades, Japan has been the silent backbone of global finance, the largest foreign holder of U.S. Treasuries for most of the last 20 years, parking its surplus savings into American debt to keep its currency stable and its export economy competitive. But that system only works when interest rates stay low and bond prices stay calm, and now that calm is broken. Japan's bond market, especially its long-dated government bonds, has begun to crack under the weight of inflation and rising yields, something that was once considered impossible in a country known for deflation and zero rates. And when Japanese yields rise, everything else starts to shake. The Bank of Japan spent years capping yields through yield curve control, essentially promising to buy unlimited bonds to keep rates near zero. But inflation forced their hand, and once the cap loosened, yields surged, bond prices fell, and massive losses appeared on balance sheets across banks, insurers, and pension funds. Imagine owning a bond that promised you almost nothing for 30 years, only to watch newer bonds suddenly pay 4 or 5 times more. That old bond becomes dead weight, and that is exactly what happened. Now multiply that problem across the largest institutional investors on Earth. Japanese institutions didn't just hold domestic bonds, they recycled capital into U.S. Treasuries, European debt, and global credit markets. And as losses mounted at home, the need for liquidity became urgent. This is where the $1.2 trillion exit narrative begins, not as a dramatic announcement, but as a forced adjustment. When yields rise and bond prices fall, leverage becomes deadly, and margin calls don't care about national pride or decades of stability. To raise cash, assets must be sold, and the most liquid assets in the world are U.S. Treasuries. Selling Treasuries pushes yields higher in the U.S., which raises borrowing costs for everything from mortgages to corporate debt, and that feeds directly into stock valuations, housing markets, and government budgets. This is why a move in Japan can ripple across the planet in weeks, not years. Historically, every major financial crisis has started in the bond market before stocks collapsed, from the Great Depression to 2008, because bonds are the foundation of credit, and when credit cracks, everything above it wobbles. In simple terms, bonds are promises, and when too many promises lose value at once, trust evaporates. Right now, global debt levels are at historic highs, government deficits are expanding, and central banks are trapped between fighting inflation and preventing market collapse. Japan sits at the center of this dilemma because it holds massive amounts of foreign debt while carrying a government debt to GDP ratio above 200% at home, a structure that only survives under low rates. As yields rise, servicing that debt becomes harder, forcing difficult choices, and those choices don't stay contained within national borders. This is where precious metals quietly re-enter the conversation. Because gold and silver are not promises, they are assets with no counterparty risk, no maturity date, and no central bank attached to them. Historically, when bond markets lose credibility, capital looks for safety, and that safety has often been found in hard assets. In the 1970s, rising yields and inflation crushed bonds and stocks while gold surged, and in 2008, after the initial liquidity shock, precious metals recovered faster than most assets as confidence in the system weakened. Today, silver carries an added dimension because it is both monetary and industrial, tied to energy transition, electronics, and technology, meaning supply constraints meet monetary demand at the same time. This does not mean prices move in straight lines, but it explains why experienced investors watch bond yields more closely than stock charts. The idea of a final crash does not mean one single day where everything goes to zero. It means a cascading repricing where assets long considered safe are forced to adjust to a new reality of higher rates, tighter liquidity, and reduced trust in financial engineering. Japan's situation matters because it exposes the fragility of a system built on the assumption that rates would stay low forever. When that assumption dies, the math changes everywhere, from pensions to mortgages to sovereign debt. The question is not whether volatility increases, it is where the stress breaks first and who is forced to sell to survive. Understanding this requires stepping back from headlines and looking at incentives, because institutions don't act out of panic, they act out of necessity, and necessity is driven by balance sheets. As those balance sheets strain, the exits become narrower, liquidity thins, and markets that once absorbed trillion-dollar flows smoothly begin to choke. Because liquidity is the invisible oxygen of financial markets, and when it starts thinning, even strong-looking systems begin to suffocate in slow motion, often before the public realizes what is happening. Japan's role in this process is unique, because for decades it has been the world's ultimate provider of cheap capital, borrowing at near-zero rates and investing abroad in higher-yielding assets, a strategy known as the carry trade. Imagine taking a loan at almost no cost and lending it to someone else at a higher rate, pocketing the difference year after year with very little risk. As long as exchange rates and yields stay stable. This strategy became embedded not just in hedge funds but in banks, insurers, and even government-linked institutions. When Japanese yields were locked near zero, there was no incentive to keep money at home, so trillions flowed outward, quietly financing deficits, stock buybacks, real estate booms, and government spending across the world. But the carry trade only works in a world of predictability, and rising yields destroy that predictability overnight. As Japanese bond yields rise, borrowing costs at home increase, and suddenly keeping money overseas no longer makes sense, especially when currency risk enters the picture. A strengthening yen can wipe out years of yield advantage in months, forcing institutions to unwind positions, not because they want to, but because risk managers demand it. This unwinding is not neat or orderly. It happens in waves, and each wave pushes yields higher elsewhere, creating feedback loops that amplify stress. When U.S. Treasury yields spike, bond prices fall, and portfolios that were once considered ultra-safe begin to show losses that cannot be ignored. Pension funds that rely on steady bond income face funding gaps. Banks see the value of their collateral drop, and governments discover that rolling over debt now costs far more than planned. This is where the idea of a $1.2 trillion exit becomes critical, not as a single transaction, but as a cumulative effect of thousands of institutions making the same decision for the same reason. Sell what you can, not what you want to. In market history, the most dangerous moments are not driven by fear alone, but by forced selling, because forced selling does not wait for better prices, it takes whatever the market offers. This is exactly how crashes accelerate. Think back to 2008, when mortgage bonds were dumped at any price to meet margin calls, or March 2020, when even U.S. Treasuries briefly seized up as everyone rushed for cash at the same time. What is different now is the scale of global debt and the limited room central banks have to respond. In the past, rate cuts and massive bond buying could stabilize markets, but today inflation constrains those tools. Central banks face a dilemma where rescuing markets risks reigniting inflation, while fighting inflation risks breaking markets. Japan's experience is a preview of this conflict playing out globally. For years, the Bank of Japan was the last defender of ultra-loose policy, absorbing bond supply and suppressing volatility, but once that defense weakens, markets are forced to reprice honestly. Honest pricing sounds healthy in theory, but in practice it reveals years of distortion. Assets priced for zero rates cannot smoothly transition to higher rate environments without pain. This is why equity valuations come under pressure as yields rise, because future earnings are discounted at higher rates, making today's prices harder to justify. Real estate fee, a squeeze as mortgage rates climb, reducing affordability and transaction volumes. Governments feel it through higher interest expenses, crowding out spending or forcing higher taxes. In this environment, investors begin to reassess what safety actually means. Cash feels safe until inflation erodes its purchasing power. Bonds feel safe until yields rise and prices fall. Stocks feel safe until earnings disappoint or liquidity dries up. This reassessment is where precious metals regain relevance, not as speculative assets, but as monetary insurance. Gold has served this role for thousands of years precisely because it does not depend on interest, rates, earnings, or policy credibility. Silver, often called gold's volatile cousin, shares monetary characteristics while also benefiting from industrial demand, making it sensitive to both financial stress and real economic activity. When trust in paper assets weakens, even slightly, capital does not need to move entirely into metals for prices to respond, because these markets are small relative to global financial assets. A modest shift in allocation can have outsized effects. Historically, periods of rising real rates can pressure metals short-term, but when rising rates expose systemic fragility, metals often decouple and perform as confidence erodes. The narrative of a final crash is not about predicting exact dates or price levels. It is about understanding structural vulnerability. Systems built on leverage, low rates, and perpetual refinancing are stable until they are not, and once cracks appear, they tend to spread along the weakest links. Japan's bond market is one such link because it represents the end of an era where yield suppression could last forever. As this era fades, investors are forced to confront uncomfortable questions about sustainability, risk, and value. Are government promises as solid as assumed when debt levels keep rising faster than growth? Can markets function smoothly when central banks are no longer reliable buyers of last resort? What happens when the largest holders of debt become sellers instead? These questions do not have easy answers, but markets will attempt to answer them through price, volatility, and correlation shifts. Understanding this context helps explain why sudden moves in yields or currencies should not be dismissed as noise. They are signals, often early ones, that deeper adjustments are underway. As more institutions prioritize survival over optimization, the focus shifts from maximizing return to minimizing damage, and that shift changes market behavior fundamentally. Correlations rise, liquidity falls, and diversification strategies that worked in calm periods begin to fail. This is usually the phase where public awareness starts to catch up. Media narratives shift from optimism to concern, and retail investors feel confusion rather than confidence. Yet by the time these signs are obvious, much of the adjustment has already occurred beneath the surface. The real danger lies not in one dramatic collapse, but in prolonged instability that erodes wealth slowly through inflation, volatility, and opportunity cost. This is why understanding the mechanics behind Japan's situation matters for everyone, not just traders or economists, because it influences retirement savings, housing affordability, and currency stability. When the world's most patient creditor begins to pull back, the ripple effects reshape global finance in ways that are difficult to reverse quickly, setting the stage for the next phase of this unfolding story, where trust, scarcity, and real value begin to matter more than leverage, promises, and perpetual growth assumptions, a phase that increasingly points toward one unavoidable question about what holds value when confidence fades. And that question leads directly to the role of real assets in a world facing systemic stress, especially when confidence in institutions, currencies, and long-standing financial assumptions begins to erode at the same time, creating an environment where investors are no longer asking how much return they can earn, but how much risk they can survive. This is the stage where history becomes a powerful guide, because while technology, markets, and instruments evolve, human behavior around fear, trust, and preservation remains remarkably consistent. In every major monetary transition, from the collapse of the gold standard to the inflationary shocks of the 1970s and the credit crisis of 2008, there comes a moment when paper claims are questioned and tangible value regains attention. Japan's current position accelerates this process because it challenges the assumption that sovereign debt from developed nations is inherently stable. When the largest developed creditor nation struggles with rising yields and debt sustainability, it forces a global reevaluation of what risk-free actually means. This does not imply immediate default or collapse, but it does imply repricing, and repricing is painful because it reveals imbalances that were hidden by artificially low rates. In this environment, gold functions less like a trade and more like a reference point, a monetary constant against which currencies and policies are measured. When central banks expand balance sheets or tolerate higher inflation to manage debt burdens, gold's lack of yield becomes irrelevant, because its purpose is preservation, not income. Silver, meanwhile, occupies a unique position because it sits at the intersection of money and modern industry. Demand for silver in solar panels, electric vehicles, medical equipment, and electronics continues to grow while supply remains constrained by declining ore grades and limited new mine development. This creates a structural tension where monetary demand driven by uncertainty meets industrial demand driven by technological progress. In past cycles, silver has often lagged gold initially, then surged as broader participation enters the metal's space, reflecting both scarcity and renewed monetary interest. Understanding these dynamics helps cut through the noise of daily price fluctuations and sensational headlines. The real story is not whether gold or silver move up or down in a given week, but why capital flows shift when confidence weakens. As Japan's capital repatriation pressures global bond markets, yields act like gravity, pulling down valuations built on cheap money. This affects not just financial assets, but real economic decisions, from business investment to consumer spending. Higher rates discourage borrowing, slow growth, and expose inefficiencies, creating a feedback loop where slowing economies make high debt loads even harder to manage. Governments respond with fiscal measures, often increasing spending to cushion the impact, which in turn raises deficits and future borrowing needs. This cycle is not theoretical, it is already visible in budget projections across major economies. The question becomes how long markets tolerate this trajectory before demanding higher compensation for risk. When that demand rises, yields rise further, and the adjustment continues. For individuals, this environment can feel overwhelming, filled with conflicting narratives and rapid changes. One day markets rally on hopes of policy support. The next they sell off on inflation data or bond auctions. This volatility is not random. It reflects a system searching for equilibrium in a world where old anchors no longer hold. In such times, clarity comes from understanding incentives rather than predictions. Central banks aim to maintain stability but are constrained by inflation. Governments aim to maintain growth but are constrained by debt. Institutions aim to preserve capital but are constrained by liquidity needs. These constraints shape behavior more than optimism or fear alone. Recognizing this helps explain why sudden shifts like Japan's bond market stress can have outsized global effects. It is not about one country making a mistake, but about a system reaching its limits. The phrase final crash captures attention, but the reality is more nuanced. What unfolds is often a drawn-out process of adjustment where purchasing power, asset values, and expectations realign. Some assets decline sharply, others stagnate, and a few quietly gain relative strength. Those gains often occur in areas dismissed during boom times as unproductive or old-fashioned. History shows that monetary resets rarely announce themselves clearly, but their signs are visible in rising volatility, policy contradictions, and growing public unease. As trust thins, the desire for simplicity grows, and simplicity in finance often means assets that do not rely on complex promises. This does not require abandoning modern markets or technology, but it does require balance and awareness. Japan's situation serves as a reminder that even the most disciplined systems can be stressed when assumptions change. For decades, low rates were treated as a permanent feature, shaping everything from retirement planning to corporate strategy. Now that assumption is being challenged, and with it, the valuations built upon it. Whether this culminates in a sharp crisis or a prolonged period of instability, the underlying lesson remains the same. Systems based on leverage and confidence are powerful, but fragile. When confidence wavers, leverage amplifies the consequences. In that context, understanding real value, scarcity, and monetary history becomes less about theory and more about practical resilience. As global markets navigate this transition, the focus shifts from chasing growth at any cost to preserving what has already been built, a shift that redefines success in financial terms and brings the story full circle back to the quiet signals that began in Japan, signals that continue to echo through bonds, currencies, and commodities, shaping the next chapter of the global financial landscape, and ultimately forcing everyone to reconsider what stability truly means in an era where the old rules no longer apply. Stability Japan's $1.2 trillion shift is not an isolated event, but a warning signal from the heart of the global financial system. Rising bond yields, massive debt, and constrained central banks are colliding in ways that expose long-standing vulnerabilities built during decades of easy money. As capital flows reverse and markets reprice, volatility becomes a feature rather than a bug, pushing investors, governments, and institutions to rethink what safety and value really mean. In this environment, understanding bonds, yields, and liquidity is just as important as watching stocks, while precious metals like gold and silver regain relevance as monetary anchors in uncertain times. The so-called final crash may not arrive as a single dramatic moment, but as a gradual realization that the financial world is entering a new phase, one where trust, scarcity, and resilience matter more than leverage, assumptions, and endless growth.